future is hot lanes. Transurban is more than a year into construction of an innovative hot lane project on a section of the Capital Beltway around Washington DC. For those of you who aren't familiar with the concept, hot lanes are tolled lanes. They operate alongside the free lanes of the freeway, but they guarantee a speed of 45 miles an hour, with the toll varying to clear congestion that will allow that speed to be maintained. Pardon me. They also help support public transport use, as buses and vehicles with 3 or more passengers in can travel free in the hot lanes. On the belt, so the tolls will fluctuate with traffic conditions to regulate demand and keep the lanes free of congestion, even in the peak times. But it's important to stress that there is always a free alternative adjacent to it. This is a solution that could have application here in Australia in some of our congested corridors in our cities. It ticks a lot of boxes, facilitating improvement in public transport, encouraging carpooling, helping to reduce emissions from congestion and keeping cities moving. It's about maximising capacity and adding value to the existing infrastructure corridors. Whatever the model applied, whether it's network pricing, managed lanes or congestion charging, it's time for government and industry to start thinking outside the boundaries of traditional toll road procurements. And we as an industry need to bring innovation to the table to ensure we continue to add value to the community over the long term. Toll roads are long-term concessions, and if we're serious about talking about delivering value, we've also got to discuss the issue of operational excellence as well. At Transurban, we know operating efficiency is a critical part of the puzzle. Roads are awarded for 30, 40, 50, sometimes 99, 100 years. So to run an asset, we need to make sure that we're running it with as much vigour on the operational period as we are worrying about the building and funding of it at the start. And the big thing here is we need to eliminate waste from our industry. The concept of single-purpose companies set up to run one asset in macroeconomic terms is a pretty wasteful concept. We have to be able to achieve synergies as an industry. I'll give you a simple example of that is really the computing systems that we've developed in Melbourne, the City of Melbourne. Connect East as a company have developed their own systems. We're in the process of upgrading our systems. The investment in the City of Melbourne is probably double what it would otherwise have been had we gotten together and made a deal that would say there was one system could have run Melbourne. Now that's just waste, and that's the sort of thing that we've got to eliminate from our industry. Running toll roads to deliver the greatest value includes maximising revenue, minimising costs and reducing risks, while maintaining a high standard of service for our customers. We need to stay focused on the changing needs of communities and be active in the management of our assets to enhance value for our investors and the community. The M1 upgrade in Melbourne is a great example where government and the private sector are working together. Our section of that road is in the middle of 2 government projects, the Monash and the Westgate, and that's going very well, on time and on budget. Looks like it's going to come in sometime in the early new year. It'll create additional lanes, remove congestion hotspots, help reduce traffic incidents and introduce the latest technology to better manage traffic flows. Community benefits estimated at $14.5 billion. And from our point of view, we'll get about a 7% uplift over 5 years on the totality of CityLink. In Sydney, we've done a deal with the RTA previously about getting more interoperability about tags, so visitors to the city can make one phone call and work on all the toll roads. Did that myself the other day. It worked very nicely. Haven't got the bill yet, but that was okay. So is there life in the model? But let's get back to the real question. Can we realistically expect that there's life in a PPP model in which the private sector accepts most of the risk? I still firmly believe that the private sector is the best party to embrace traffic risk in our case, price it and get value for it in delivering significant new road infrastructure. Projects in which users are charged for the benefit delivered and the private sector bears the risk that people will choose to use the road will continue to offer a strong, viable model for delivery of our road infrastructure needs. While the value of this model is clear, there is unfortunately good reason why it's being questioned at the moment. It's understandable that people remember the write-downs and disappointing traffic numbers rather than the quiet successes. Our key challenge is to rebuild confidence. To do that, we have to have an honest discussion about what's gone wrong. The way I see it, there are 5 groups, key groups involved. Firstly, the community through the government. Second, promoters. Third, constructors. Fourth is debt. And finally, equity. First and most importantly is the government, or the community represented by the government. They're the ultimate client of any road. They want the road built to get the community outcomes. Mainly political risk, but regardless of how the road performs and how the investors ultimately fare, the community will get the high-quality asset that they wanted. If the financial performance of the vehicle turns out to be less than required, the government may pick up a bit of residual political risk on the back end of that. Second and third are the promoters and constructors. In Australia, this is a very small professional group of companies, deep knowledge of the challenges, very efficient industry sector, and their job's ultimately to win the deal, get it constructed and make their normal processes on profits and so on the way through that process. Fourth are the debt providers. Obviously critical. You saw Steve's numbers earlier about the debt proportion in these projects. Debt's critical to ultimate success. They want to see strong counterparties, but they get first crack at the cash flows from the operations. Good projects can still attract debt, albeit I agree with Steve's point that there probably will need to be higher equity contributions into new projects in this current market, and I think that's going to be around for quite some time. And equity ultimately is the collective of people, finally, who are the ones who are prepared to put their own money at risk, knowledge of the business risks and confidence in the ability of the management in whom they place their trust to deliver, all with the expectation of earning a return on that investment. They're the last people to be paid, yet they take the highest risk. We believe that the owner-operator model, which we adopt at Transurban, provides the best means of aligning all of those interest groups. It ensures an interest in the long-term success of the project beyond just the deal, just the road, just the construction or just the financing. We want success throughout the life of the asset. Ultimately, equity is the one that loses the most if they've taken the wrong risk, and when it comes to risk, there's no bigger risk in this business than traffic forecasting in the pricing and structuring of road infrastructure projects. We need to take a more careful, considered approach to traffic forecasting. It's a combination of science and art. We try to recommend the science. When considering a prospective road, we take account of some observations on our existing similar roads. This graph takes a little bit of understanding, but this is CityLink outbound on the Southern Link. It shows each blue dot is 1 hour observation. What this shows is that as the traffic gradually builds up until we get to about 5,900 cars per hour over 3 lanes, we can tolerate that sort of traffic, and then the traffic flow actually turns back on itself, so the numbers start to reduce. You can see that the speed holds up somewhere between 80 and 90 kilometres per hour up through about 3,500, then it drops to the lower end of that range. And I'm not sure if this will work. There's a laser pointer. Here we go. Yeah. Up through about here, you see the speed. This line is the volume of cars. The speed starts to drop, and as we get to, it's just under 2,000 cars per lane per hour, the traffic turns back on itself. Now that's CityLink. That's sort of a road that's now relatively mature. So when we come to traffic forecasting, and if you see something that says greater than 2,000 cars per hour per lane, ask yourself the question, why will it be better than CityLink? So there's there is an incentive to err on the side of optimism when forecasting traffic in contested bids, and I think we've got to be realistic about that and make sure